There were a lot of spikes last week on Friday. The general stock market spiked down on Friday, gold and silver spike up. What's going on? Firstly, thank you for being a member at myfinancesteacher.org. I will also post this on YouTube with a delay of several hours. So if you're watching this on YouTube, consider joining us at myfinancesteacher.org. Clearly, the drop in the stock market and a spike up in gold was due to renewed tensions or perception of this higher tension between Russia and Ukraine. We saw US warning of an invasion taking place any day now. And to be honest, I don't want to go into a political debate here in the comments. Let's just look at it from the perspective of our investments. The way I see it is there are mostly a couple of scenarios here. One, which is I think more likely, is where this tension de-escalates over the next several days. And another, which would be tragic, is when tension escalates and perhaps something more serious actually takes place. In my opinion, I do think tensions are more likely to de-escalate over the next few days instead of us seeing Russia actually invade Ukraine. I think the tensions between Russia and Ukraine are used by the US administration as some sort of an outside distraction from some sort of troubles that the US politics is going through right now. And again, I don't want to jump into any political debates over here, but looking at how the current administration is doing, we see that by early 2022, the approval rating has dropped to the lowest level over the last couple of years, and the disapproval level has increased to the highest level over the last couple of years. So in my opinion, the tensions in Russia are less likely to escalate into a tragic hot war, but are more likely being used for four reasons. First is a bit of a distraction, outside distraction from what's going on with the politics within the US and now neighboring Canada as well. Secondly, of course, always do follow the money. These tensions have allowed the US to go on with arms sales to Ukraine. We see a second shipment of US weapons coming into Ukraine recently. Unfortunately, it's always profitable for the military-industrial complex to see a war going on somewhere in the world. And even if no war, at least some sort of tensions or perceived tensions to sell more arms into those foreign countries. The third reason is perhaps the ongoing situation is used just to tighten the screws a little bit more on the sanctions against Russia. And fourthly, we have the Nord Stream 2, the second natural gas pipeline going along the Nord Stream 1. The building of this second pipeline has been completed, but the actual exports of natural gas from Russia to Germany, as far as I'm informed by now, hasn't started. And as much as Europe might actually need some energy resources at the moment with crude oil above $90, perhaps this tension again between Ukraine and Russia is also used to block that Nord Stream 2 from coming online and increasing European dependence on Russian energy, hence increasing Russian influence somewhat. So these are potential reasons, in my opinion, that these tensions between Russia and Ukraine are used for, and instead of leading to an actual hot war, perhaps they're going to de-escalate over the next few days. So with that in mind, let's have a look at what are the scenarios for our general stock market as well as precious metals, gold. My original scenario is represented over here with a solid black line. My perception was that the previous intermediate cycle that started in early October finished being relatively short, finished in late January. And that scenario is still the dominant one. Perhaps the likelihood of this scenario is now decreased from somewhere over 90% conviction to perhaps down to 60% conviction. And the alternative scenario here, denoted with this dotted line, I would perhaps give it a 35-40% chance, 35-40% conviction, is that the previous intermediate cycle, which started again in early October, is still ongoing. After all, usually these intermediate cycles do last for around half a year. So perhaps we are going to see one more short-term daily cycle within the continuing intermediate cycle. If that is the case, perhaps we're going to see the end of this cycle sometime into mid-March, because that's when our next FOMC meeting is, and perhaps the expectations of another rate hike might drop the general stock market further down into that upcoming intermediate cycle low. So that is our 35-40% chance scenario, while the 60% chance scenario is that we are going to recover over the next short term. But again, with these rate hike expectations, I think volatility is still going to stay with us for a while. And again, sometime into the second half of the ongoing daily cycle, we are going to see a bit of a drop down into that rate hike in mid-March. After that, within the dominant scenario, we see a rally into the second short-term daily cycle. But again, perhaps we're not out of the woods with all of these Fed rate hikes expectations. Perhaps we are not going to really see any significant new all-time highs on the general stock market before we see another cool down into the following FOMC meeting, which will be in early May. Here's the expectations for the upcoming mid-March meetings, and in the previous video from a few days ago we saw that the markets were expecting a 50 basis points hike with a certainty of over 90%. By now this certainty has dropped down to 56%. So in a very weird way, this softness in the stock market as of Friday might actually mean that the Fed isn't going to be as hawkish, meaning that at least within our main scenario, the drop into that FOMC meeting might not be as severe. But still, as I mentioned, we still have some volatility in the stock market over the next several weeks into May as well. As the markets expect more rate hikes into May, we see an expectation of a 75 basis points hike by May with a conviction of over 50%, and perhaps even a 1 percentage point rate hike with a conviction of 20%. So just as I mentioned in the previous video, still some agility is probably a good thing in the stock market in the ongoing intermediate cycle. Perhaps buying on the dips sometime close to the recent lows, that's somewhere around 42, 4300, followed by selling at resistance levels, perhaps somewhere around the 50-day moving average, 46, 4700 on S&P, might actually be a good idea. That's what I will try to do. I will try to unload my positions somewhere around this consolidation area, let's say around 4700 on S&P, sometime at the top of the second daily cycle. That's if the dominant scenario actually takes place. Let's see what happens as the markets open on Monday. And again, as I mentioned, we got to be a bit agile here. I think we're going to start with a bit of a green candle. What's going to happen after that still remains to be seen. Of course, nobody actually knows the future. So what I'm going to do on Monday morning as the markets open, I'm going to raise my stop losses to somewhere below the Friday low to protect the capital in case if that intermediate cycle from early October continues down into the intermediate cycle low. So these are the scenarios for the general stock market. Before we move on to gold, let me remind you to join us at myfinancesteacher.org. The membership fee is only $10 a month, so it's just like buying me a beer a week. Cheers. Now moving on to gold again. I still do have the same scenarios, although perhaps I might turn out to be wrong with this relatively significant move in gold last week. The main question still remains whether the intermediate cycle that started in August has actually finished over here in the middle of November. If that is the case, which I still think has less than 50% chance scenario. Perhaps we're going to increase the conviction of that scenario maybe from 40% to 45%, but to be honest, usually these geopolitics spikes in gold price are not sustained if you look back at history. Still, somewhere around 40 and 45% chance for this scenario, the dotted line, where the intermediate cycle is the new one from mid-December, meaning that gold is generally going to trend higher with higher highs and higher lows. We still are likely to see a bit of a drawdown into that FOMC meeting by mid-March, followed by another rally into a new short-term daily cycle. But our 55 to 60% chance scenario is when the intermediate cycle is still ongoing from early August. It could be a little bit more painful in the short term, but perhaps the longer term potential of this scenario is actually better, as the new intermediate cycle will have longer to rally after that FOMC meeting. So with this scenario, the main scenario illustrated with this solid black line, I expect the gold price to come down a bit more significantly into the intermediate cycle low by mid-March. How low is it going to come down to? Well, that still remains to be seen, but again, as I mentioned in the previous video, one of the support zones that has been respected a couple of times over the last few months is this 1760. That might actually turn out to be our correct intermediate cycle low over the next few weeks. And after that, we might see a push into a new intermediate cycle with a bit of a more explosive move in gold. And I do think the highs somewhere around 1920 are going to be strong resistance, but perhaps with the gold breaking out of this handle of the cup and handle formation, might attract more attention and start a bit of a faster rally. We'll see what happens, but for now, these are my scenarios. But again, nobody does know the future, so I do want to know, what do you think? Let me know what you think in the comments below. And in the meantime, while I'm waiting for your comments, I hope you had a nice weekend and I wish you a productive Monday. Bye-bye.